With SoFi Technologies trading right around the $18.33 mark, sitting roughly 40% below its multi-year peaks after a volatile correction cycle through early 2026, Wall Street is once again missing the forest for the trees. Turn on financial television or scroll through retail investing forums on Reddit and X, and you will hear the same tired narrative that SoFi is just another digital bank, a glorified online lender vulnerable to credit defaults, or a high beta momentum play heavily tethered to interest rate cuts. Traditional financial media analysts look at a trailing price-to-earnings ratio hovering near 38 and hastily label the stock expensive for a bank, completely failing to understand the structural reality of what Anthony Noto and his engineering team have actually built. They are treating a digital infrastructure titan like a regional credit union, entirely blind to the underlying physics of software-driven financial services scalability. Retail investors scanning apps like Robinhood or Public see sharp daily price swings and get shaken out by macro headlines, mistaking short-term sentiment shifts for fundamental business deterioration. Meanwhile, the structural reality is that SoFi has decoupled itself from legacy brick-and-mortar banking constraints. The true bottleneck in modern consumer finance has never been customer demand. It is the archaic, fragmented legacy tech stack that traditional financial institutions rely on, glued together by decades of technical debt, batch processing, and high marginal costs. While legacy institutions spend billions simply maintaining mainframes, SoFi engineered a proprietary, vertically integrated, cloud-native financial services ecosystem and technology platform that turns software into a compounding moat. The market mispricing stems from an institutional inability to value a company that is simultaneously scaling a hyper-growth consumer super app and an enterprise software-as-a-service infrastructure engine. As institutional algorithms fixate on quarterly net interest margin fluctuations, they ignore the compounding lifetime value of a platform adding over 1 million members a quarter, while expanding its technological gatekeeper footprint across the entire digital economy. Looking closely at the daily trading volumes and order flow dynamics, SoFi exhibits classic high beta characteristics that frequently trap emotional retail capital. Following its blockbuster quarterly prints, such as the second quarter of 2026, where adjusted net revenue crossed a record $1.2 billion, up 40% year-over-year, alongside an adjusted EBITDA of $358 million, the stock experienced immediate algorithmic sell-offs driven by short-term traders hyperventilating over second-half margin execution targets and unchanged full-year guidance. This is the classic institutional shakeout playbook in action. Smart money heavyweights use these post-earnings liquidity events and macro rate jitters to absorb shares from weak-handed retail investors who panic at the sight of high expectation hurdles. The institutional accumulation pattern during these deep pullbacks reveals a stark divergence between how short-term momentum chasers and long-term asset managers view the enterprise. While retail sentiment swings wildly based on whether the Federal Reserve cuts rates this month or next, institutional desks are modeling the multi-year expansion of SoFi's tangible book value per share, which surged over 50% year-over-year to $7.34 per share. The heavyweights understand that every wave of market uncertainty forces weaker fintech competitors to pull back, leaving SoFi with a clear runway to capture higher-income prime credit consumers at lower customer acquisition costs. They are quietly building massive block positions while the daily retail chatter focuses on transitory noise. Before we dive deeper into the operational mechanics, let's check in on where you stand. How many shares of SoFi are you currently holding in your portfolio, and are you actively accumulating during these pullbacks, or are you sitting on the sidelines waiting for a confirmed breakout? Drop your thoughts in the comments below. To truly understand why SoFi's current valuation framework is so misunderstood, we have to look past the outdated historical framing that categorizes the company as a mere student loan refinancing startup from the early 2010s. Back in its formative years, SoFi, short for social finance, began as an alumni-funded lending platform targeting high-potential graduates. If you judged the company by that legacy lens today, you would completely miss its radical evolution. Through a masterclass in strategic execution, highlighted by the pivotal acquisition of Golden Pacific Bank Corp and the Galileo Financial Technologies infrastructure, SoFi transformed itself into a national digital bank holding company and an enterprise software powerhouse rolled into one. Today, the business operates across three distinct, highly synergistic pillars: the lending segment, the financial services segment, and the technology platform. The lending segment, encompassing personal loans, student loans, and home mortgages, generates massive, predictable cash flow and high returns on equity, fueled significantly by the low-cost deposits secured through its national bank charter. Those deposits act as the ultimate competitive advantage, allowing SoFi to fund its loan origination machine at a fraction of the cost faced by non-bank lenders. More importantly, the financial services segment has erupted into a powerhouse, housing SoFi Money, SoFi Invest, Credit Card, and Relay, which together now account for the vast majority of total product additions. The brilliance of this everything app strategy is the aggressive acceleration of cross-buy behavior. Over half of all new products opened are by existing members already embedded in the ecosystem. Meanwhile, the technology platform, powered by Galileo and Technisys, acts as the plumbing for hundreds of millions of digital accounts worldwide, providing fintechs and traditional banks alike with modern account processing and payment infrastructure. While old-school analysts view SoFi through the narrow prism of consumer lending cycles, the reality is that it is scaling a dual-engine model, combining high-margin recurring software service revenue with a hyper-efficient digital banking titan. Looking ahead over a multi-year horizon, SoFi's growth catalysts are anchored by structural tailwinds that position the company as an indispensable technological gatekeeper in digital finance. As mega-cap tech spenders and traditional financial institutions alike race to modernize their infrastructure, demand for scalable API-first banking-as-a-service solutions will only intensify. SoFi's ongoing integration of artificial intelligence across its engineering workflows, customer service channels, and credit underwriting models is structurally compressing operating expenses while driving record member growth, surpassing 15.8 million members and nearly 24.4 million total products. The raised full-year 2026 adjusted net revenue guidance of $4.75 billion to $4.85 billion underscores a management team executing with supreme confidence despite a higher-for-longer interest rate backdrop. However, prudent risk management requires acknowledging legitimate challenges. Key execution risks include the necessity for strong second-half margin expansion to hit full-year EBITDA targets, potential macro credit normalization across unsecured personal loans if economic headwinds intensify, and competitive pressures within digital banking and payment processing. Furthermore, any unexpected shifts in regulatory capital requirements or compliance mandates for digital bank holding companies could introduce friction. Yet these are operational hurdles, not structural flaws. Investors who fixate on short-term price noise miss the broader destination. SoFi is methodically compounding intrinsic value, expanding tangible book value per share, and cementing its status as the definitive digital financial utility of the modern era. Looking past the daily ticker tape and focusing on the underlying compounding machine is the exact edge that separates generational wealth creation from retail noise trading.